On Tuesday morning in Hong Kong, while most of Wall Street was still asleep, a government-owned company most people have never heard of processed its very first gold settlement. No press conference fireworks, no dramatic countdown clock, just a quiet transfer of bars between vaults. And yet within hours, Bloomberg terminals in London, New York, and Zurich all lit up with a brand new ticker symbol that had never existed before in the history of gold trading. 3 letters, HAU. If you didn't catch that happening this week, you missed what might be the most consequential shift in how gold gets priced since the London Gold Fix was created almost 100 years ago. I want to be careful with how I frame this, because the words gold reprice get thrown around on this platform constantly, usually attached to something that turns out to be much smaller than advertised. This is not that. This is a real, verifiable, government-backed infrastructure launch, and I've spent the last several days going through the primary sources, the Hong Kong government's own filings, the exchange data, and the reporting from outlets that don't traffic in hype, to understand exactly what changed this week and what it actually means for anyone holding gold or silver. So let's walk through it properly, because the headline version and the real version are not quite the same thing, and the difference matters enormously for how you think about this market going forward. Here's the setup. For roughly 100 years, the price of gold that the entire planet references has been set in 2 places. London runs the benchmark auction, twice a day, 10:30 and 3 in the afternoon London time, administered by ICE Benchmark Administration, and that number, the LBMA gold price, becomes the reference point for essentially every gold contract, every central bank valuation, every jewelry manufacturer's cost basis, everywhere on Earth. New York runs the futures side through COMEX, part of CME Group, and that's where the speculative, leveraged, fast money lives, setting the short-term direction that London often ends up following. Between those 2 cities, for a century, the world has been told what an ounce of gold is worth. Not Beijing, not Mumbai, not Dubai. London and New York. Think about how strange that actually is for a second. Asia buys more physical gold than anywhere else on the planet. China and India alone account for a massive share of global jewelry and investment demand. And yet, for the entire history of modern gold trading, the region doing the most actual buying has had almost no say in what price that gold changes hands at. That imbalance is exactly what Hong Kong just built a system to challenge. On July 7th, Hong Kong's financial services and the Treasury Bureau, working through a wholly government-owned entity called the Hong Kong Precious Metals Central Clearing Company, began trial operation of what officials are calling a full-chain gold trading ecosystem. That phrase sounds like bureaucratic filler until you understand what it actually covers. Trading, clearing, settlement, physical storage, and delivery, all built and operated inside Hong Kong using 400-ounce gold bars that meet international good delivery standards, the exact same specification used in London. 41 institutions participated in that very first batch of transactions, according to Hong Kong government filings, spanning banks, mining companies, refiners, and jewelers. This wasn't a soft launch with a handful of local players testing the water. Bank of China Hong Kong is serving as the settlement institution and designated vault. HSBC has confirmed it's expanding its Hong Kong gold storage capacity toward 200 metric tons. And according to Caixin's reporting, the board overseeing this new system includes 11 banks, among them JPMorgan, Citigroup, and UBS. Read that list again. These are not fringe players trying to build an alternative to the establishment from the outside. These are some of the largest bullion banks on the planet, the very institutions that have run the London and New York system for decades, and they are now sitting on the board of the thing that's supposed to compete with the system they built. Have you noticed how often that pattern shows up in finance? The people with the most to lose from a new system frequently end up being the ones who help build it, because they'd rather have a seat at the table shaping how it works than watch it develop without them. Keep that thought in your head, because we're going to come back to what it tells you about how seriously to take this whole story. So what exactly is this new HAU price? Here's where I want to slow down and be precise, because a lot of coverage this week has blurred an important distinction. HAU is not today a replacement for the London gold price. It is a new reference rate specific to Asian trading hours, live on Bloomberg, designed to fill what officials describe as a genuine gap. Right now, when London and New York traders go home for the night, gold trading in Asia has continued for decades without its own authoritative benchmark, largely tracking whatever price New York left behind and adjusting from there. HAU is meant to give Hong Kong its own anchor during the hours when it's actually doing the most trading, rather than importing a stale number from a market that's asleep. Alongside HEU, Hong Kong also launched something called Delivery Connect, a mechanism built with the Shanghai Gold Exchange that allows two-way transfers of physical gold between vaults in Hong Kong and vaults in Shanghai. Three banks, Bank of China Hong Kong, HSBC, and Industrial and Commercial Bank of China Asia, completed the very first transfers under that scheme on day one. What that quietly accomplishes is significant. It stitches Hong Kong's new clearing infrastructure directly into mainland China's enormous domestic gold market, the Shanghai Gold Exchange, which is already one of the largest physical gold markets in the world by trading volume. You're essentially watching two of Asia's biggest gold markets get plumbed together in real time, with tax incentives, expanded vault capacity, and even early exploration of yuan-denominated gold futures contracts sitting on the roadmap for what comes next. Now, why does any of this actually matter for the price of gold in your portfolio? This is where I think a lot of the excitable coverage this week either overstates the case or completely misses the actual mechanism. So let's slow down and get this right. The theoretical argument goes like this. For decades, critics of the Western gold market have pointed to a structural quirk. The paper market, meaning futures contracts and derivatives traded in London and New York, is enormous, many multiples larger than the actual physical gold that exists to back it. Under normal conditions, that's fine, because most paper contracts never get converted into physical delivery, they simply get closed out or rolled forward. But it also means that a huge volume of paper selling can, in theory, push the quoted price of gold below what physical buyers in Asia are actually willing to pay for real metal in hand. When that gap opens up, arbitrage traders are supposed to step in and close it. What Hong Kong's new infrastructure does, at least in theory, is make that arbitrage faster, cheaper, and more direct, because gold can now settle and physically move between Hong Kong and Shanghai vaults without needing to route through London or New York intermediaries first. If paper selling in the West pushes prices low relative to what real physical buyers in Asia are willing to pay, that gap becomes easier and cheaper to exploit and close. That doesn't mean the influence of Western paper markets disappears. It means the cost of maintaining a gap between paper price and physical reality goes up, and in markets, rising costs change behavior over time. Is that a real mechanism? Genuinely, yes, and it's worth taking seriously rather than dismissing outright. Is it going to reprice gold overnight, the way some headlines this week have implied? No, and I think it's important to say that plainly, rather than let the hype run ahead of the substance. This is not a light switch. Hong Kong's system launched in trial mode. It is starting with a defined, limited set of participants and building the kind of deep, trusted liquidity that London took a century to accumulate does not happen in a single trading session, or a single month, or probably even a single year. Here's a detail that should tell you how seriously the market is actually taking this, even in trial mode. In the run-up to launch, gold import volumes into Hong Kong ran meaningfully above the typical two-year seasonal average, at a point in the calendar that's normally a quiet lull for mid-year bullion flows. That's not regulators putting on a show for the cameras. Banks don't move real physical metal ahead of a system going live unless they expect genuine transaction volume once it opens, and the very first day of live trading appeared to confirm that expectation. Hong Kong's US dollar gold futures on HKEX hit a record on July 6th, with 6,676 contracts traded in a single-day session, more than double the previous all-time high of just over 3,000 contracts, a record that had stood since November of 2022. That's not a rounding error. That's the market showing up in force right as this infrastructure came online. Let's talk about the skeptical side of this story too, because I don't think you're well served by a one-sided narrative. And there is a real credible skeptical case here that deserves airtime. Ding Meng, chief economist at China CITIC Bank International, put it plainly this week. Asia genuinely needs a more active gold trading center during its own time zone, he said, but this isn't really about wresting pricing power away from New York and London. It's better understood as a useful supplement to the pricing mechanism that already exists, not a replacement for it. That's a meaningfully more measured framing than Hong Kong just declared war on the bullion banks, and it's coming from someone sitting inside a major Chinese financial institution, not from a Western skeptic trying to talk the story down. There's also a structural vulnerability worth naming, honestly, because I think it's the single most important open question hanging over this entire project. Hong Kong's system depends on a genuinely delicate balancing act, drawing credibility simultaneously from major global systemically important banks like JPMorgan and UBS on one side, and Chinese state-linked institutions like Bank of China and ICBC on the other. That dual-track model works beautifully as long as geopolitical relations between Washington and Beijing stay reasonably stable. But picture a scenario where US-China tensions escalate meaningfully from here, and Western regulators or shareholders start pressuring global banks to pull back from participating in Chinese-linked financial infrastructure. In that scenario, Hong Kong's system doesn't disappear, but it likely loses the international legitimacy it needs to function as a genuinely global benchmark, and ends up operating more as a China and Belt and Road aligned regional pricing mechanism rather than the worldwide reference rate its architects are hoping to build. That's not a hypothetical dreamed up to sound dramatic. It's a realistic outcome analysts covering this launch have specifically flagged as one of the more plausible paths this story could take from here, and it's exactly the kind of geopolitical fragility that separates a headline-grabbing launch from an institution that actually endures for decades. Let's talk about the historical parallel here, because I think it's the piece of context that makes this story click into place. This isn't the first time a rising economic power has tried to build its own pricing infrastructure to challenge an incumbent financial center. Shanghai has been trying to establish itself as a genuine global gold pricing hub for well over a decade, launching the Shanghai Gold Exchange's own benchmark back in 2016, denominated in yuan, specifically to give Chinese buyers and sellers a domestic reference point. And it's worth being honest about how that story actually played out. The Shanghai benchmark exists, it's used extensively within China, but it never displaced London as the global reference price the rest of the world quotes contracts against. Foreign capital controls, currency convertibility limits, and a lack of deep two-way liquidity from international participants all kept it from becoming a truly global benchmark, even with the full backing of the Chinese state behind it. Hong Kong is different in one crucial respect that's easy to overlook. Unlike mainland China, Hong Kong operates under its own currency, its own regulatory framework, and decades of established credibility as a genuine international financial center with free capital flows. That's precisely why global banks like JPMorgan, Citigroup, and UBS are willing to sit on this board in a way they never would for a purely mainland Chinese initiative. Hong Kong is in a real sense trying to borrow Shanghai's ambition and pair it with London's institutional trust, and that combination is exactly what makes this launch worth taking more seriously than the Shanghai benchmark's decade-long struggle for global relevance. I also want to touch on what this means for silver, because gold tends to dominate this conversation while silver quietly rides along in the background, even though the mechanics matter just as much there, arguably more. Silver's physical market is considerably smaller than gold's in dollar terms, but the paper-to-physical ratio in silver has historically been even more stretched than in gold, which is part of why silver tends to move so much harder in both directions whenever physical tightness becomes a genuine issue. Hong Kong's initial rollout is focused primarily on gold, but the Delivery Connect scheme with Shanghai and the broader vault expansion plans on the roadmap explicitly include silver as a next phase. If that infrastructure eventually extends the same physical settlement advantages to silver that it's building for gold, and given how much tighter the global silver market already is, running a sixth straight year of deficit as we've covered before, that's a combination worth watching closely rather than assuming it stays a gold-only story indefinitely. Could this be a trap for anyone rushing in based purely on excitement rather than understanding the mechanism? Here's where I'd urge some genuine caution, separate from the skepticism about geopolitical fragility we already covered. New financial infrastructure in its trial phase almost always overshoots in the headlines relative to what it delivers in year one. The Shanghai benchmark didn't reprice gold in its first year or its fifth. Even the LBMA's own modernization efforts, moving from the old telephone-based gold fix to the current electronic auction system back in 2015, took years to fully earn the market's trust after launch. Trial operation status matters here. Hong Kong's own officials have described this explicitly as a trial, not a finished, fully scaled system, and the sensible expectation is a multi-year build-out, not an overnight transformation. If you're positioning your portfolio around the assumption that HAU displaces the London fix by next quarter, you're trading a headline, not a market reality. And that's exactly the kind of expectation that gets retail investors burned when the pace of change turns out to be far slower than the excitement implied. There's a bigger picture worth connecting here, because Hong Kong's launch doesn't exist in isolation. It's landing at exactly the moment when central banks worldwide are already engaged in the most sustained gold buying campaign in decades, adding somewhere close to 850 tons to global reserves this year alone, according to industry projections, nearly double the average pace that was normal before 2022. That shift accelerated dramatically after Russian dollar reserves were frozen following the invasion of Ukraine, an event that fundamentally changed how reserve managers around the world think about holding assets that another government can freeze with a signature. China's central bank has been buying gold for 20 consecutive months running, and it kept buying straight through this year's worst quarterly price decline in over a decade, which tells you this isn't opportunistic trading, it's deliberate, long-horizon strategy. Hong Kong's new clearing infrastructure fits neatly into that same broader current. If you're a central bank in Asia, the Middle East, or anywhere actively trying to reduce dependence on Western financial plumbing, having a credible, physically backed settlement system that doesn't route through London or New York, and that in Hong Kong's case explicitly sits outside the reach of certain Western sanctions regimes, is not a minor convenience. It's exactly the kind of infrastructure a sovereign reserve manager wants available before they need it, not after. That's really the through line connecting everything we've discussed today. None of these individual pieces, a new price ticker, a clearing company, a handful of banks moving physical metal between Hong Kong and Shanghai, sounds particularly dramatic in isolation. But layer them on top of record central bank buying, a persistent silver deficit, ongoing de-dollarization pressure, and a Western banking system that's voluntarily helping build the alternative it's supposed to be competing with, and you start to see the outline of a genuinely structural shift, even if the day-to-day price action this week has been dominated by oil headlines and Fed speculation instead. So where does that leave the price of gold right now? Because I know that's ultimately what most of you watching this actually care about. Spot gold was trading right around $4,130 an ounce at the moment this system went live in trial mode, itself sitting well off the all-time high above $5,500 the metal touched back in January, and still absorbing the shock of a genuinely volatile few weeks, driven by the unraveling ceasefire with Iran, a spike in oil prices, and a Federal Reserve that's currently split on whether its next move is a rate cut or, remarkably, a rate hike. Gold's multi-year bull run has clearly hit real headwinds from rising energy costs, renewed inflation concern, and higher expected borrowing costs, all of which traditionally weigh on an asset that pays you no yield while you hold it. Hong Kong's new plumbing doesn't erase any of that near-term turbulence. What it does is add a new structural current running underneath the surface, one that plays out over years rather than days, alongside the trend of central banks around the world steadily diversifying their reserves away from the US dollar, which we've discussed at length before on this channel. Would this actually change how you should think about buying gold or silver today? I'd frame it this way. If you're trying to trade the next few trading sessions, Hong Kong's clearing system is not the variable that matters. Fed commentary, the Iran situation, and the next employment report will move price far more than settlement infrastructure most traders have never even heard of. But if you're thinking in years rather than days, this is exactly the kind of structural development that's easy to dismiss in the moment and obvious in hindsight a few years later. The pattern is familiar if you've watched enough market history unfold. Infrastructure gets built quietly, gets shrugged off by people focused on tomorrow's headline, and then one day the market wakes up and realizes the balance of power shifted while everyone was watching something else. If you're someone who wants clear, research-based analysis on how the plumbing of these markets actually works, instead of the kind of noise that turns every announcement into either a nothing burger or the end of the Western financial system, that's exactly the kind of channel I'm trying to build here. So make sure you're subscribed, because we're going to keep tracking exactly how much volume actually flows through this system in the months ahead. There's a psychology piece worth naming here too, because it explains why this story is being covered so differently depending on where you're reading about it. A chunk of the coverage this week, particularly from sites that have spent years predicting an imminent collapse of Western paper gold pricing, has framed this launch as the final nail in the coffin for London and New York's control over the metal. I understand the appeal of that framing, and there is a real mechanism underneath it worth taking seriously, which we've walked through today. But treating a trial phase clearing system with 41 initial participants as an immediate death blow to a century-old pricing structure that still processes the overwhelming majority of global gold trading volume gets ahead of the evidence. On the other side, some mainstream financial coverage has been almost dismissive, treating this as a minor regional initiative not worth much attention at all, which undersells just how significant it is that JPMorgan, Citigroup, and UBS agreed to sit on the board of infrastructure explicitly designed to eventually challenge the system those same banks currently profit from running. The honest read sits between those two extremes, and honest reads rarely make for the most viral headline, which is exactly why you have to dig past the headline to actually understand what happened this week, because that's more useful than speculating about outcomes nobody can know yet. Watch HKEX futures volume in the weeks after this trial period, because if that record session on July 6th turns out to be a one-day novelty rather than a sustained pattern, that tells you the market isn't ready to lean on this infrastructure yet. Watch how many additional banks and institutions formally join the clearing system beyond that initial batch of 41 participants, because broader adoption is the difference between a genuine benchmark and a niche regional experiment. And watch the relationship between HAU and the London price during Asian trading hours specifically, because if a persistent tradable gap opens up between what Hong Kong is pricing gold at and what London settles it at later that day, that is the single clearest signal that physical reality in Asia is starting to pull away from paper pricing set in the West. Is this a trap? Some of you might be wondering. A story engineered to get retail investors excited about a change that ultimately benefits the same large banks sitting on its board. I don't think that's quite the right way to read it either. The banks on that board aren't running a trap. They're doing what large financial institutions always do when new infrastructure emerges that could plausibly matter, which is make sure they're inside the tent rather than outside it. That's not manipulation. That's just how institutional finance has worked for as long as institutional finance has existed. I genuinely want to know what you make of this. Do you think Hong Kong's system meaningfully dents London and New York's grip on gold pricing over the next few years? Or does it end up as a well-funded regional supplement that never quite breaks through to true global benchmark status? Tell me your honest read in the comments, because this is exactly the kind of structural story where informed disagreement is more useful than everyone nodding along. And if you found this breakdown useful, take 30 seconds to like the video and pass it along to anyone who's been asking you why gold's pricing mechanism even matters in the first place, because most people holding this metal have genuinely never thought about where the number on their screen actually comes from. Here's the honest summary of everything we've covered today. Hong Kong didn't flip a switch and reprice gold this week. What it did was lay the first real piece of alternative plumbing that Asia has ever had at this scale, backed by serious institutional money, built with the full participation of the same global banks that have run the old system for generations, and specifically engineered to shrink the gap between what paper markets say gold is worth and what the people actually buying and holding physical metal in the world's biggest gold-consuming region are willing to pay for it. Whether that plumbing becomes genuinely load-bearing or stays a well-built but underused side channel is going to be decided over the next several years, not the next several days, and I'll be tracking every meaningful data point along the way. I'll see you in the next one.